Statement of changes in equity for the year ended 31st December 2002. So as we discussed before, that equity, this is the money which belongs to the owners of the business. So this is called shareholders contribution, shareholders wealth, shareholder worth according to the balance sheet. So mostly shareholders are very much interested in equity because this is something which belongs to them. So it usually consists of four components. We call that share capital, share premium, retained earnings and reserves. But just to make it simple, I'm just putting here three. I said share capital, retained earnings and revaluation surplus. So you start it at the beginning of the year, that when your financial year started, at the beginning of the year, your balance on 1st January 2002, this is actually coming from 31st December 2001. So this is the same balance from previous year. The closing balance of last year becomes opening balance of this year. So the share capital was X dollars, then you had retained earnings, then you had revaluation surplus, and you make a total. So this is your total for the equity. So this is the money which belongs to the shareholders. Then what happens that during the year, the activities during the year, number one is issue of share capital. Maybe we issued more shares. So shareholders, they invested more money in form of share capital. This will be added. And then what happened that dividends were paid out. So if any dividends are paid out, they are subtracted from retained earnings. So you minus the retained earnings, those dividend. If there is any revaluation gain, so total comprehensive income, it goes to revaluation surplus. So these are the three activities which were related to equity during the year. For example, like we said that new share capital introduced, retained earnings, dividends given and revaluation, and plus you add here profit for the year. So during the income statement of 2002, whatever you calculate the profit, you put it here in the retained earnings. So this is added. So last year retained earning plus this year profit minus the dividend given, it gives us the retained earning balance. Then you have share capital balance, you've got revaluation surplus balance, and you make a total. So at the beginning of the year, your total equity probably is 1 million. Now at the end of the year, it is 1.5 million. So there is a $500,000 increase in the equity statement. We call it changes in the equity. So this 1 million, it became 1.5 million. Why it became 1.5 million? How much was the change in share capital? What is the change in dividends? And in the revaluation surplus, etc. So this is a very simple format of statement of changes in equity, but this should be enough for your F3 purposes. Yes, when you move on to F7 or you go on to SBR, the statement becomes a little bit more complex, but the idea is the same. The concept is the same, that you take your opening balance of equity plus minus any changes in share capital, share premium, retained earnings or reserves. Any changes in these four items, those are reflected, and then you come down to your closing balance of equity. So these are the three financial statements which we discussed. Income statement, which was statement of comprehensive income, then balance sheet, we called it statement of financial position, and statement of changes in equity. The fourth statement, which is cash flow statement, that will be covered in next chapter because it's a major statement, cash flow, and we have a separate chapter for that. So you will watch cash flow chapter separately, and I will explain that statement in that chapter. So that's all for this chapter. It was a short chapter. It is done. We will move to the next topic now.